The tax planning mistake number 3 that business owners make, the failure to fund an HSA account annually. Now, an HSA account is a health savings account. It's money that, it's actually better than an IRA. Married couple can put in around $6,700, and a single person, half of that, around $3,500. You can put in money each year into an HSA account and you get a tax deduction on the front page of your tax return. I've seen nothing in the bill, legislation, or changing that at all, the HSA. They talk about taking away the medical expense deduction, but President Trump has been talking about, he likes the HSA, and I think it's something he wants to keep, okay? So this is a hidden thing that you should be trying to do in HSA. You have to have a high deductible medical plan in order to have an HSA. Some companies who have the old plans that are low deductibles, you would not qualify. Also, when you turn 65 and go on Medicare, you cannot put more money into an HSA at that point in time. Because when you go on Medicare, you can't do the HSA. But the nice thing about an HSA is you get a tax deduction for it. And when you take it out to pay medical expenses, you don't pay any tax. And the money is invested. You can invest the money in the stock market, so you can accumulate money over time, and you don't pay any tax on the earnings. So the HSA is a really good tax-advantaged account. The family is $6,750, and if you're over 50, it's an extra $1,000, so it's $7,750. The single is $3,350, and if you're over 50, you can put an extra $1,000 in. So the HSA is a good account, and I'm going to mention something else that business owners should consider, is a health reimbursement arrangement for your employees. You can set up a health reimbursement arrangement, especially because there's no deduction for medical expenses. They haven't seen anything they're going to get rid of the HRA account, health reimbursement arrangement, okay? So we're going to be looking on the radar for that, because that's something that employees can put money away on a monthly basis out of their paycheck pre-tax. It's like a 401k. You make an election to take money out, and you can do it as needed. It doesn't have to be a certain amount every month, but they can take money out, not pay tax on that money, put it into the HRA account, and then take it out the month later to pay their bills. So even if you can't put money away, you want to have an HSA or an HRA. Even if you can't afford to put money away, you want to set it up, and you put the money in the account, get a tax deduction for it, and then you take it out next month to pay your bills. So you may not be able to accumulate, but at least you're going to be able to get a tax deduction.
When you take it out, is that taxable?
It's tax-free. Tax-free, okay? So the HRA is something that I'm going to be looking for that, especially when they're taking away Schedule A deductions for medical expenses. Now keep in mind, who has significant medical expenses that are in excess of 10% of their income? Cancer people, stroke people, elderly, nursing home, Alzheimer's, dementia. Think about when you think about tax policy, what are they doing? Do you know that 1 out of 8 bankruptcies today are because of medical expenses? It's not going to get any better. But that's the yin and the yang when they're up there in Congress and they're looking at what deductions they're going to take away and doing all this magic, and are they really going to get ahead? I don't know, quite frankly. Okay. Any other questions or anything?
What was that HRA?
Health reimbursement arrangement. Okay. Any other questions?